How are you coming up on the late morning here on Wall Street? And it's time for a quick reset. I'm Grant Mercer. This is Storm Stock Solutions, and the tone right now is all about digesting the Fed's latest move and what it means for 2026 and beyond. The big new wrinkle over the past hour is the growing focus on the idea that the Fed's most recent rate cut might be the last one for a while. According to MarketWatch reporting, officials have now stepped back after that cut, and the question in the real economy is shifting from how low can rates go to how long do they stay here? That's showing up immediately in housing chatter, refinancing decisions, mortgage affordability, and debate over whether locking in now is smart or a potential misstep if conditions change. On the flip side of that same macro coin, you've got a very bullish take from fundstress Tom Lee, highlighted by MarketWatch, arguing that this Fed backdrop could help drive roughly a 10% gain for stocks in 2026, even with a wall of worry in front of 2026, even with a wall in front of the market. That kind of optimistic forecast tends to keep growth and risk assets in play, but it also raises the bar. If the data or the Fed path diverge from that story, sentiment can swing quickly. So that's a clear area to handle with some care from an expectations versus reality standpoint. Under the surface, the labor market data is adding an interesting twist. Jobless claims spiked to a 3-month high after Thanksgiving. But as MarketWatch points out, the move looks heavily distorted by the holiday, and there's still little evidence of a wave of layoffs. Traders are reading that as soft landing still intact, rather than a hard turn warning, which supports the idea that the Fed can pause cuts without immediately choking off growth. In terms of sector and stock themes, healthcare is quietly back on the radar. A MarketWatch piece notes that healthcare as a group screens relatively cheap versus the broader U.S. market after several years of a bull run. Professionals are watching that as one of the healthier corners of the market if investors start to rotate away from the most expensive parts of the S&P 500. Then in the background, one under the radar story to flag. Disney's billion-dollar story to flag. Investment in OpenAI, reported by MarketWatch, with a deal that lets fans create short on-form clips using Disney characters. That's part IP licensing, part AI content BAP. It's the kind of crossover between traditional media and generative AI that could reshape how investors think about legacy media valuations and growth narratives if deals like this start to scale. Looking into the next hour, watch how futures and rate-sensitive names respond to the idea that this may be the Fed's last cut for a while, and whether the Tom Lee-style optimism continues to buoy cyclical and growth areas into the afternoon. We'll also see if that labor data narrative, holiday noise versus real weakness, gets challenged by any fresh commentary. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Storm Stock Solutions, I'm Grant Mercer. Stay sharp, stay steady.